Cast is now starting. All attendees are in listen-only mode.
Good evening, everyone. Thank you for joining us for today's webinar on Budget Analysis 2019. We will be joined in a minute by all the speakers, so kindly be with us. We shall begin shortly. Some of the topics that our speakers will discuss today are the government's proposed vision for 2030, tax landscape, and the recent GST updates. Joining the discussion today are Manisha and Bhadresh Vyas. Manisha is a practicing chartered accountant and Bhadresh Vyas is the Director, Indirect Taxes at SKP. Welcome, everyone. We are happy to have you host today's webinar for all our listeners. Kindly note that all our listeners are in listen mode only. If you have any questions, please share them with us through the question box on the right-hand side of your screen, and we will address your queries at the end of the webinar. Without any further delay, we shall start the webinar. Over to you, Manish and Bhadresh.
Thank you for the introduction and good afternoon. So this is Manish and I would be discussing about the direct tax proposal. So as we all know that this is the election year and as there's a lot of expectation on the government to dole out some of the benefits, particularly with respect to the farmers and the salaried and the middle class. And to a large extent, the government has been able to keep up that particular promise, although not all the expectations have been fulfilled, as we will see in the presentation. So let's look at some of the key highlights with respect to the economy. So as Mr. Piyush Goyal has mentioned in his budget speech, the direct tax collection has gone up from 6.38 lakh crore to nearly about 12 lakh crore in last 5 years. The inflation has been kind of tamed at 4.6% of the GDP, which is a commendable achievement from over 10%, which used to be there prior to 2014. Fiscal deficit, there has been slight slippage. The expected fiscal deficit was 3.3%, but it has been packed at 3.4% of the GDP because of some of the benefits which have been given in this particular budget. The implementation of insolvency and bankruptcy code has resulted in recovery of 3 lakh crore, which is a good achievement. There is a transformation as far as the taxpayer and income tax department is concerned, in the sense that the physical presence of the taxpayer has been drastically reduced, and this is going to further reduce over a period of next 2 years because of the introduction of e-assessments. Mr. Piyush Goyal spelled out a 10-point dimension to achieve the long-term vision of making India US dollar 10 trillion economy over next 10 to 12 years. There have been a lot of benefits which have been given to the farmers and poor and backward class people. The most importantly is Pradhan Mantri Kisan Yojana, where the government is going to spend 75,000 crore in the period 1920 by providing a direct cash benefit to the farmers of 6,000 rupees per annum who are having land of less than 2 hectares. Budget for Manrega has been fixed at 60,000 crore. With respect to the animal husbandry and fisheries, there has been interest subvention of 2% on loan availed by this particular industry. And another benefit which was not really expected is with respect to mega pension scheme for workers in the unorganized sector, where a pension of rupees 3,000 per month would be given post retirement, who are drawing salaries of less than 15,000. So this is a very good benefit which is provided to the workers, somewhat similar to the social securities provided in the Western countries. Let's discuss about the direct tax proposal. There was a lot of debate which was going on whether government will come out with a full-fledged budget and where it would contain many direct tax proposal, or since this is an election year, so as the protocol demands that government would just present a vote on account, the government has actually chosen a path, a middle path. So it's neither a complete vote on account nor it is a full-fledged budget, but it's kind of an interim budget, and whereby the government has tried to provide some tax benefits to the middle class citizens, and particularly the salaried class. So let's look at the various proposals. The first and foremost is that there is a tax rebate which has been provided for the taxpayer who are returning net income of 5 lakh rupees. So this would mean that there is no increase in the basic slab rate. Currently, the basic slab is 2 lakh 50, up to which there is no tax which is payable. So those who have heard the speech of the finance minister, at first blush, people got the impression that the basic exemption limit has been increased from 2,50,000 to 5 lakh, but that is not the case. The benefit has been provided by way of the tax rebate, which means that on an income of 5 lakh, currently the person pays 12,500 tax. The slab rate is between 2,50,000 to 5 lakh. The slab rate is 5%. So person would end up paying 12,500 tax. So what the government has done is that they have increased the limit of tax slab up to 12,500, which means that when you are returning income of 5 lakh rupees, you don't pay any tax by virtue of the tax rebate of 12,500. And of course, if person is making investment in any eligible scheme under ATC of which is available 1 lakh 50, then up to 6 lakh 50 it does not pay any tax. There was expectation that even the limit of deduction under ATC would be increased. The current limit is 1,50,000 for specified investment in PPF, PF, LIC, etc. However, there has not been any change as far as the ATC investment limit is concerned. The second proposal is with respect to increase in standard deduction for salaried class. The standard deduction has been introduced in the last finance bill of 2018, which was 40,000. This is now increased from 40,000 to 50,000. Both these proposals, that is increase in tax rebate as well as increase in standard deduction, they are going to benefit about 3 crore taxpayer. And this move is quite smart in the sense that the taxpayer will continue to file the tax return because these benefits are not coming by way of increase in the slab rates, but they are coming by way of increase in standard deduction and increase in tax rebate. So that way, government will be able to keep tab of the taxpayer, and at the same time, the benefit has been provided to the taxpayer by way of relief in the tax payment. Another benefit which has been provided is with respect to the taxation of notional rent. As you all must be aware that currently, if you are owning a house property, then with respect to one house property, it is considered as self-occupied and there is no tax is payable. But if you own more than one house, then the second house is considered as deemed let out and the fair rent of that particular house is required to be offered for tax. The government realized that in a current situation with the family splitting, it is quite possible that a person may require two house property, and hence they have provided that as long as if a person is owning two houses, even with respect to the second house, the deeming let out provision would not apply, and the deeming let out provision would be applicable only when a person is owning more than two houses. So this is a very welcome relief which has been provided. Another relaxation has been provided with respect to withholding tax provision. So currently the TDS is applicable in respect of payment of rent. The current limit is 1,80,000, which has been increased to 2,40,000. And with respect to fixed deposit interest, currently any interest earned in excess of 10,000 rupees attracts withholding tax at the rate of 10%. That limit has been now increased from 10,000 to 40,000. So this would again provide a substantial relief to the pensioners and to the senior citizens and even other taxpayers as well. There is one more provision where again relief has been provided, and that is with respect to capital gains tax exemption. So currently there is section 54 which provides an exemption with respect to capital gain arising on account of sale or transfer of a residential property and where the capital gain is invested in another residential property. The current provision restricts the benefit with respect to purchase or construction of only one residential property. Again, the government realizes that if a particular family is selling a property and if they are in need of more than one house, let's say if the person has got two sons and if they intend to buy two houses, that the current provision does not provide for that benefit. The benefit is restricted to purchase or construction of only one residential house. So government is now extending this particular benefit of the purchase or construction of residential house to two properties. But there are the conditions. The condition is that the capital gain on sale of property should not be more than 2 crore. And the second condition is that this benefit would be available only once in a lifetime of that particular taxpayer. But again, this is a quite a welcome provision. Here in this particular table, we have given the calculation as to how the increase in rebate would operate. So there are two columns. So we have given the income. Let's say if the income is 9,50,000, and if the person is availing of all the various tax benefits which are available. So you have the benefit available of 2 lakh rupees for a payment of interest on housing loan. Then you are availing standard deduction under section 16 of up to 40,000 rupees. You are availing the deduction under section 80C of 1,50,000, and you are also availing deduction under 80CCD with respect to contribution to National Pension Scheme (NPS) of 50,000. In that case, if you bring down your net income to 5 lakh rupees, then as I had mentioned that on 5 lakh rupees, the tax payable based on the current tax rate would be 12,500. And now the rebate under section 87 is proposed to be enhanced to 12,500, which means that you don't pay any tax. So if you are earning income of 9,50,000 and if you take avail of all these tax benefit, then you don't pay any tax. But we have to keep in mind that if your net income is instead of 5 lakh rupees, if it is 5 lakh 1,000, even if it is 1 rupee more, then the benefit of 87A rebate would not be available. So if you look at the column 1, where if your net income is coming to 5 lakh 10, then you end up paying tax of 25,000. But if your net income is exactly 5 lakh rupees, then you don't pay any tax. So this aspect one has to keep in mind. As far as corporate entities are concerned, as such, nothing changes much. So, and people were not really expecting much changes with respect to the corporate entities. But just for the sake of completeness, we will just run through some of the provisions. So last year in the finance bill, a provision was introduced that the companies whose turnover is less than 250 crores in financial year 16-17, they will have to pay tax at the rate of 25%. So for financial year 19-20, the provision continues, but the turnover limit has to be seen with respect to financial year 17-18. There has not been any change with respect to capital gains tax or dividend distribution tax or minimum alternate tax MAT. As far as there is a deduction available under section 80 IAB with respect to affordable housing project. Of course, this deduction is available not only to corporate but for any other assessee, which provides for 100% of deduction with respect to the profits earned from this particular project. This benefit was available only with respect to the housing projects which were approved up to 31st March 2019. To give boost to the affordable housing, the government is now proposing to increase the limit up to 31st March 2020. So, which is again a very welcome move, and it actually goes with the intended objective of government to provide a house for everybody. There is some benefit which has been provided to the real estate industry, and again that goes with the intended objective of providing house to everybody. Currently, the provision provides that with respect to the properties which the real estate players have constructed, and if they are unsold, then up to a period of 1 year, the notional rent will not be computed with respect to those unsold property, and only after a period of 1 year, the notional rent would be computed. This benefit of 1 year is now proposed to be extended to 2 years, so which is again a welcome for the real estate players, because currently there's a lot of unsold inventory, and it is hitting the real estate player hard, because on one hand they are not able to sell the property, and on the other hand they are asked to pay the tax. So this proposal will give a lot of relief to real estate players. Coming to some of the administrative aspect of the direct tax, so which again is which was mentioned in the budget speech. It is with respect to the e-assessment. So everybody would have actually experienced that in financial year 18-19, the e-assessment process has already started. And the objective basically is to reduce the harassment to the taxpayer and reduce the interface of the taxpayer with the tax department. And it would also help in reducing the time and the cost. And more importantly, it would actually help in curbing the discretionary powers of the tax authorities and a reduction in corruption. And we are actually seeing that it has been reasonably successful. And the idea of the government now is that over next 2 years, it would be a complete there will be complete e-assessment proceedings, and the entire assessment would actually be done by a specialized team, not even the jurisdictional officer, but by a specialized team, which may also include some tax expert. So this would actually be kind of a very transparency. It would bring in a lot of transparency and accountability in conducting the assessment proceedings. Some of the other highlights of the last 5 years of this government is that there has been considerable increase in the tax payer or the tax returns which have been filed from 3.79 crore to about 6.85 crore. Mr. Piyush Goyal also mentioned that 99.54% tax returns have been accepted as filed. So only in case of 0.46% the matters have been selected for the scrutiny assessment. The government has already given approval for the technology-based processing of the return, which is a massive project. And this would actually help in processing the returns within 24 hours and issue of refunds also within 24 hours. So this is going to be a very, very commendable achievement of the government. And as I mentioned, that it is establishing the anonymized back office to carry out the assessment, without any interface with the tax department, and this would be done by the tax official as well as tax expert. So again, it would reduce the arbitrariness and corruption in the department. So these were, as far as this particular budget is concerned. But I would take a little liberty and take this opportunity to take you through the recent tax landscape and some of the important development which has been happening. So the first and foremost is with respect to the angel tax issues. I mean, everybody must be reading these burning issues since past a couple of months. The issue was the issue is arising on account of the provision of 56 to 7B, which has been introduced by 2016 Finance Act. Just for the benefit of all the listeners, the provision is like this, that any company, when it is receiving the consideration for issue of shares at premium, and if the consideration received is in excess of the fair value, then the difference between the consideration and the fair value is considered as taxable income. Now, so this particular provision is causing a lot of problem for mainly for the startups, as they are receiving a huge kind of a share capital and a share premium. And the issue is arising with respect to the fair valuation, whatever valuation which they are obtaining, whether it is fair or not. And the dispute is arising on account of that. So a lot of startups have received tax demand and a lot of pressure from the department to recover those particular demand. Last year, the CBDT had come out with a circular that no coercive action would be taken, and they have also come out with the relief provisions that if a startup is receiving share capital up to rupees 10 crore, and if they have got approval of the interministerial board, then the valuation would be accepted. But still the controversy is continuing, and people were expecting some kind of relief in this particular budget, but it has not come through. So one would have to still wait for the government clarification by the circular. Some of the other important issue, software taxation again continues to be a burning issue, that whether payment for software is royalty or not. Fortunately, Supreme Court has fixed up a date of 19th February, and so hopefully one could expect that in this financial year, one could hear from Supreme Court the final word on the taxability of software. The Indian government has been pretty active as far as the implementation of the base erosion profit shifting, or popularly known as BEPS measure. And in line with the BEPS measure, where with respect to taxation of digital economy, a recommendation was made of introducing equalization levy, which Indian government had already introduced again in 2016, and which is operative. So it's not something not new, but what we have experienced that collection on account of equalization levy is not that great, and government had notified at that point of time several other services which also could be introduced at later point in time. So today it is only online advertisements which are covered under equalization levy, but because if the collections are not good, then other services like downloading of software or other things also could get introduced under equalization levy. Another important area is with respect to digital presence or digital permanent establishment. This is again in line with the BEPS measure. Globally, all countries are actually experiencing that the e-commerce is now sweeping its way, and some of the companies are earning billions of dollars, though they do not have any physical presence in any particular country. And India also is one of the country which is kind of deprived of its legitimate share of tax revenue. So in line with the BEPS Action Plan 1, India had introduced the concept of significant economic presence in the last budget, that is budget of 2018, whereby it had made the provisions that if any of the company has made significant sales in India, or if it is continuously soliciting business from India, then it will be regarded as deemed to have a significant economic presence in India, and accordingly the income could get taxed. However, the government has still not, kind of specified what is the limit by which, above which, if it crosses, then it would be considered a significant economic presence. So, to that extent, the provision still remains kind of unoperative. And also, this is the amendment which has been made in the tax laws, but so far so far the treaties have not been amended. So, to that extent, wherever any country has got a treaty with India, then to that extent the companies coming from those countries could get a protection. But the thinking is very clear to tax this type of company, and we will see in the future years that this type of companies would come within the tax ambit. The important question here is that with respect to these digital transactions, we are actually experiencing multiple taxation. So one is, of course, we are talking of the direct tax, but we should not forget that all these sales also attract GST on reverse charge mechanism. So it could result into a multiple taxation, which one should be aware of. The another important point is with respect to the permanent establishment. Again, in the BEPS action plan, there has been amendment in the definition of permanent establishment, and the definition is getting widened. And even where any agent who is playing a principal role in procuring the order, although they may not be concluding the contract, could still be regarded as a permanent establishment of the foreign entity. Again, this particular provision has been introduced in last year by the Indian government, and it is now forming part of the tax laws. But I must say that even without introduction of this particular provision, the Indian tax authorities were already applying these particular provisions, and they are actually examining in detail wherever any entity or any subsidiary of the foreign company which is operating in India as a marketing arm, they are very thoroughly examining the arrangement and actually also examining the conduct of the party to see that what kind of role they are playing. And we have recently two judgments, one with respect to Daikin and one with respect to GE, where the Indian tax authorities have concluded that the presence of the Indian entity constituted permanent establishment in India, and accordingly they have attributed the income of the foreign entity in India. So one has to be very, very mindful and careful as to what kind of activities the Indian arm of the foreign entity is carrying out, because the Indian government has been applying this particular provision, and now with introduction of BEPS, the Indian government has kind of got a shot in arm to apply this provision more vigorously. But of course, there is currently no guidance available on, even if suppose permanent establishment is established in India, what percentage of profit needs to be attributed. So currently, different courts are coming out with different percentage, and under the law also there is no clear-cut guidance is available. So it would be good if the government clarifies some of the guidance on attribution of profit. Another burning issue in transfer pricing is with respect to the AMP, or the advertising and marketing promotion expense. As you all must be aware that large multinational companies, subsidiary operating in India, particularly in the FMCG sector, they are incurring a huge advertisement expenditure, and it is the stand of the Indian revenue authorities that if they incur the advertisement expenditure above a particular threshold, which is they call it as a bright line test, then the foreign parent should reimburse that particular expenditure to Indian entity, and on account of that, huge additions are being made in the hands of the Indian subsidiary. So this is a burning issue, and we have kind of a few high court judgments which have taken a favorable view that the incurrence of expenditure on account of advertisement and marketing by the Indian subsidiary on a standalone basis cannot be regarded as international transaction, and hence there is no need for the foreign entity to reimburse that particular expenditure. But we are yet to hear the final verdict on this from the Supreme Court, and one is eagerly waiting on the final verdict of this. But till that time, the controversy continues, and we hear that even in current financial year, the additions which have been made are huge, and I think probably it is 30 to 40% more as compared to the last financial year. So the controversy continues till the Supreme Court gives the final verdict. One more important aspect I would like to touch upon is with respect to the prosecution. This government has been pretty active as far as prosecution is concerned and the implementation of the tax law. 5 years ago, we hardly used to hear anything on the prosecution, and in fact, we as a professional also hardly read any provisions with respect to prosecution, because it was not really kind of the tax authorities also were not really keen to pursue that particular remedy. But now we are actually seeing that the prosecution is also kind of approached by the tax authorities at the drop of the hat, and we have various instances. So the first and foremost is with respect to TDS payment. So even if there is kind of shortfall in TDS payment, we can actually expect a prosecution notice. And there are other instances also. If the tax returns are not filed, then there is a prosecution. We have also seen the instance where the advance tax payment has not been made and the prosecution notice has been issued. So the government has now become very active as far as prosecution is concerned, and hence again everybody has to be very careful while complying with the law. And government should also exercise some kind of a restraint, because they should also lay down some kind of a threshold before initiating the prosecution proceedings. Otherwise, the promise of non-adversarial tax regime by this particular government would kind of go for a toss. So this were the direct tax proposal and some of the raging issues with respect to direct tax. I would be happy to take any questions on these particular issues once the indirect tax proposals are done with. So I will now hand over the proceedings to my colleague Bhadresh, who would take you through the indirect tax proposals. Bhadresh.
Thank you, Manish. So this was the last budget before India would go for the polls, the general elections, which are due in May. There were expectations that this budget would be a populist budget, though with GST being in place, where all the major decisions are to be taken in consensus with the state governments by way of GST council meetings, there was actually very little room available for FM to propose any major changes from the GST law perspective. However, on the customs front, there were clearly expectations by trade and business, mainly with regard to rationalization of rates to support the Make in India initiatives. Healthcare industry has been demanding exemption from levy of customs duty on life-saving drugs and certain medical devices. FICCI also had asked for cut of excise duty on CNG, because petroleum products are still not subsumed under GST. Consumers Electronics and Appliances Manufacturers Association had asked for increase in customs duties on the finished goods such as televisions, air conditioners and refrigerators. However, none of this or other representations that were made by various trade forums and associations have been accepted in this interim budget. The finance minister took this budget rather as an exercise or this budget exercise as an opportunity to showcase the reforms that were carried out by the government so far. So he mentioned some few reforms that were carried out under the GST law and customs in his speech. He also mentioned that this is not merely an interim budget, but a medium for the country's development journey. So the focus, which clearly appeared to be on digitization and automation of tax procedures, mainly with an objective to avoid interface with the tax office, is clearly evident from his speech. Again, on the tax reform measures, use of RFID seals, which are already implemented for customs, and online return filings and refund procedures. One can easily say that those all are measures which are moving towards digitization and automation of tax procedures. Subsuming of petroleum products and electricity under GST still remains a talk of future, as there are no announcements in this regard. In his budget, the FM mentioned about some few GST reforms which already have been notified or rather publicized by way of various GST council meetings. He said that exemption for the small businesses who have a turnover of 20 lakhs, that has been increased to 40 lakhs. So basically the threshold limit for registration under GST has been increased from 20 lakhs to 40 lakhs. This would be effective from 1st of April 2019. But here a point of concern is that now each state government would be at a liberty to select the threshold limit applicable in their respective states. So the apprehension or the fear that one has is, are we moving towards a regime which was prior to GST? Because if each state government comes out with a different threshold for registration, then one nation, one tax theory may fail to that objective. Another relief measure which the FM mentioned in his speech was that small businesses who have a turnover up to 1.5 crore Indian rupees have been given a composition scheme, and where they have to pay only 1% flat rate and will have to file only one single return, an annual return. This again is not effective as of now, but yes, from 1st of April 2019, under the revised return filing mechanisms and all, this will be effective. Similarly, for small service providers who are into services, not the goods, and have a turnover of up to Indian rupees 50 lakhs, would be allowed to offer a composition scheme where they would be paying 6% GST instead of the normal rate of 18%. This again is already publicized, but it will be made effective from 1st of April 2019. There was also a mention in the budget speech that businesses who would be allowed to file quarterly returns, and that would cover almost 90% of the GST payers. This again is not notified as of date, but as per the plan, when the revised way of filing returns would be made effective, this proposal also would come along with that. So where there the turnover is less than 5 crores Indian rupees, the person would be allowed to file a quarterly return instead of the monthly returns as per the current practice. Barring this few mention of reforms which already has been carried out or publicized, there are no major announcements with regard to indirect tax laws, neither under the GST law, nor under the customs law. But there have been certain developments in the recent past which we have captured here. One is the way in which the returns will be filed going forward. So presently, we all know that there are two returns which are to be required to be filed every month. GSTR 1, which is a return of outward supplies, and GSTR 3B, which is a summary return, which are required to be filed on a monthly basis. Government has proposed that they would revamp this entire return filing mechanism, and then a simplified return filing would be in place, where a person would have to declare his return of outward supplies, similar to what one is doing presently under the GSTR 1. But basis the declarations, the recipient of a goods or service will have to log into the web portal, the common web portal GSTIN, and would have to freeze the liability of the supplier. And input tax credit to the recipient would be allowed basis that. So this would be a major change from the existing systems where GSTR two-way reconciliation is ideally required to be carried out at the time of annual return. That going forward would become a real-time exercise. Because if I have to avail input tax credit, I would have to log on to the web portal and would have to freeze the GST outwards which have been declared by my suppliers. Only basis that I would be allowed an input tax credit. The government is still titling this as a simplified return mechanism because the disclosure requirements would be curtailed in that. Date for GSTR 1 and ITC 04 has been extended. There's also talk of the simplified return for composition dealers, which would be effective from 1st of April 2019 under the revised set of return filings. Certain changes were also made in the GST annual return format and the audit exercise. So for the period July 17 to March 18, India would be filing its first GST audit reports along with annual returns by 30th June, which is the current due date. Online utility files for submission of GST annual return and audit report is still not publicized, but the format was declared, and after trade and business made various representations, the government has made certain relaxations in the reporting requirements in those formats. So one major change is with regard to disclosure of all our input services and input goods HSN wise. So at the time of filing monthly returns, the reporting requirement is only on the outward supplies where I have to declare HSN wise summary of my outward supplies. Similar disclosure requirement is not there on terms of procurement or on terms of inward supplies, which was asked in the inward annual return, which government has now clarified that reporting requirement would be only for the top 10% of the HSNs and not for the entire procurement. Also, annual return, earlier there were debates whether it's a mere compilation of 9 months return or whether it would also be an opportunity for trade and business to rectify and amend any errors or omissions that could have been done at the time of filing the monthly returns. So the way the revised format has been publicized now for the annual return, it says it would be for the period July 17 to March 18 and not necessarily declared during those periods. So if there were any gaps or omissions in reporting monthly returns, then annual return would be an opportunity to declare those supplies and turnovers. In terms of input tax credit availment, again there were myriad amendments which would be effective from 1st of February. The two major ones are in terms of allowing input tax credit for motor vehicles used for certain purposes which has a capacity of more than 13% including driver. So that earlier was under the restricted category. Now input tax credit would be available. Another relaxation is given from the negative list is for the expenses made for employees which are mandated under any law. So if I have a factory and under a mandate of law I need to provide food facility to my employees. Earlier there were debates whether ITC would be available or not, which has been now clarified amply clear that input tax credit would be available if I am making any expenditure for use of my employees which is mandated under any other law. There are a couple of various other amendments also which will be made effective or are to be effective. From 1st of January, reverse charge mechanism has been introduced on security services. Kerala has been given a right to introduce the 1% cess for all transactions of supply within the state of Kerala. So basically this is to deal with the natural calamity of flood that they faced. But this again has raised apprehensions in trade and business because it would have different tax rate for supplies within the state of Kerala vis-a-vis the normal GST rates. So again, one nation, one tax theory partially is defeated for the state of Kerala. This cess is yet to be notified from which date it would be effective. There are announcements with regard to e-way bills, which says that if a person has failed to file consecutive 2 months tax periods return, then he would be debarred from generating an e-way bill. Also, there's a proposal which says that e-way bills details would be auto-populated while filing the GSTR1 on the web portal, because quite a few fields are common between GSTR1 and e-way bill. So those would be auto-populated and the person need not enter it again. So these were some major announcements which were made in the GST Council meetings, not in the Union Budget, but obviously this is an interim budget, and we can see that the focus clearly is on digitization of tax reform procedures and ease of filing returns. So we can expect that once the new government would present the final budget, there would be still certain pronouncements around these areas. So this was from the direct tax and indirect tax perspective, the amendments that were made in the Union Budget and in the recent past. We are ready to take any questions either from the direct tax or indirect tax side, which one could have.
If you have any questions, please share them with us through the question box on the right-hand side of your screen, and we will address them.
Yeah, I have received one question that with respect to this rebate, whether from which year this would be applicable, because immediately after the finance minister's speech, the finance secretary, when it appeared that the benefit of this rebate would be available for the current financial year, that is 18-19 itself, when you file your tax return. But when we look at the finance bill and the proposal, it very clearly mentions that this particular rebate under 87A would be available for the financial year 1920, that is the assessment year 2021. So, based on the provisions, it is very clear that it will be available from next year onwards. But if the intention was to provide that this benefit would be available for current financial as well, then they need to amend the finance bill to that extent.
There's a question from an indirect tax perspective as well. It says, is GST on unregistered dealer procurement effective from 1st of Feb? Okay, so the answer is no, it's not effective. Other than services provided by security, this was I would say, a point of debate, or on certain WhatsApp messages and social media, this was the question that was floating around. Government has amended the provisions. Earlier there was a notification which said that if I have a procurement from an URD, then reverse charge mechanism GST is rescinded. That notification has been withdrawn, and therefore there was a view that GST on procurement from URD is again made effective, but that's not the case, because under the law, amended law, which is made effective from 1st Feb 2019, they have made a provision which says that they will have to come out with a list and they will notify what all services would attract GST under reverse charge mechanism. Right now, only services of security when provided by a non-body corporate to a body corporate is notified. So other than those, reverse charge mechanism doesn't apply under the GST law.
Thank you, Manish and Bhadresh, for taking out the time to share your valuable insights with us. We hope that the insights shared by our speakers have been useful for all of our listeners. Thank you once again for joining in.